Welcome to Direct Credit Funding. I am Credit Carl with Jason and Alex. How are you guys today?
Very good. Thank you, Carl.
That is good. Hey, this episode for our regular audience and to our new audience, thank you. Make sure you hit that subscribe button. This is a special episode. I've put this together myself. Jason, I thank you for trusting me.
We'll see how you did, Carl. We'll see how you did.
Ye of little faith. Ye of little faith. Okay, so for those listening to this, these numbers are not real numbers, but they're pretty close to factual numbers based on the following. We're going to do a scenario of why we overlook the percentage rates of the interest that you get.
Right.
In terms of running a business, opposed to, let's say, your credit card rate or your mortgage rate. Obviously, as direct credit funding, you guys only lend to businesses.
Right. Which we've talked about the difference between good debt and bad debt. And good debt is debt that makes you money. And that's the example. And I hope they actually put a nice whiteboard up with this, and I hope they put it on the screen to show you that good debt is debt that's going to make you money. And so in the case of the business, and we're going to go through these examples, is it worth, being your interest rate being at 10%, 20%, or God forbid you're at 30% for your situation? Regardless of your interest rate, does it make sense in your business model to take advantage of this financing? Is it going, and I'll let you continue, Carl, but I'm hoping we get a whiteboard up on this for the screen.
See right here to the left of me, there's the numbers right here we're going to talk about. So that's a great segue, Jason. So we're going to go on this synopsis. This is a $10,000 loan at 60 months. Okay? We're going to go with 10%, 20%, and 30%.
Okay.
Jason, I know you know math. You've been doing this for 26. You probably dream of numbers, knowing you.
Probably.
What is the monthly payment on a 10% loan at $10,000?
On a 10% loan, we're going to do this in three grades. We've got an A, a B, and a C.
Okay.
And an A is going to be at 10%. The monthly payment on $10,000 at 10% is $210 a month. So of that $210, $43 a month is going towards the interest payment, and the rest is the original part, repaying the $10,000 that you borrowed. If you're a B credit grade and your rate is 20%, your monthly payment is going to be $260. Of that, $93 a month is going to be interest. And in example number 3, 30% interest, your monthly payment is $315 a month, of which $148 a month is interest. And these credit grades have been determined because of your personal credit experience in your business. What the point of this example is it worth you as a business owner not getting this piece of equipment because you think you deserve a 10% interest rate, and I'm not going to borrow money at more than 10% because that's what my dad said, and I shouldn't have to pay more than that. Well, you're going to pay a $210 a month payment. But let's say for your situation, we can't approve you at a 10% rate, and you end up getting approved at 20%. And your payment's $260 a month. So you're $40 a month more a month in payment going out. Are you not going to grow your business? You're not going to take on a piece of equipment that can make you $5,000 a month more because it's going to cost you $40 a month more in payment? That doesn't seem to make any sense.
That's where you hit the home run, Jason. And Alex, you've done this. The home run that you hit was, if this machine and equipment is going to make my business $5,000, my return on investment, ROI, credit Carl, know what that means. You've had this conversation, Alex, where people will walk away from a deal saying, I don't want 20% or maybe 30%. But from the business perspective, Credit Carl used to own a business. I need my machines to run my business. What's the conversation you tell the customer? Hey, look, we're looking at $105 a month difference. But you're going to make, in this example, again, this is purely an example audience, a $5,000 machine. Like $5,000 more a month. Make the math make sense for us.
You bring up a very good point, and this is something to go over with customers often, especially since, like you said, a lot of people look at their rate. A lot of time it's the first thing they ask because they want to know whether or not they're getting a fair rate. And the fact is that these high rates of up to 30% do happen sometimes. If a company is a startup and they've got almost no cash flow, that will affect their rate. And it just will. We try and get around it as best we can, and obviously we try and get our customers the lowest rates that we can, but it doesn't always happen. And the important thing to remember is that, like Credit Carl said, like Jason said, whatever equipment you're going to purchase for your business, its return on investment should far exceed whatever you're going to be paying in interest and in payments.
Well, one thing that we did talk about this, Jason, if you remember on one of our earlier episodes, make sure you hit that subscribe button, everybody, so you can go listen and hear these great topics, is that there's no early penalty payoff. So in this example, if I'm making $5,000 more a month, let's say 6 months down the road, I'm not doing the math right now, but
Sure.
I realistically could have the loan paid off. There's no penalty to me.
No, there's not. You can pay it off early and not have a penalty. And if this equipment starts generating the substantial income that you're expecting and things go well, yes, you can pay this off early so you can purchase more equipment and keep growing your business.
And Credit Carl says it helps your credit when you pay it off early, right?
It does help your credit when you pay it
In
off
some
early.
situations.
In some situations.
I'm a little excited to say I love this conversation. I was talking to fellow business owners, and the synopsis was they need almost $25,000 on average across the nation. You're looking between $20,000 and $25,000 any individual needs just to start up a company. So you have to have the expectation that your credit may be higher per interest rate, but the value of what you're bringing in, as you said, Alex, that ROI is so important. If you're in this situation, if it's on the screen right now, if I'm gonna generate $5,000 more, but it's gonna cost me $100, I'm making $4,895 extra a month. That
Yes.
would make sense.
Even if you're paying what, the 30% rate?
Yes, at 30%.
Yes. And that's what and that's what needs to be determined when you're purchasing equipment is because ultimately you're writing off all of this anyway. It's all a depreciable asset. It's a tax gain. But how much income is that equipment going to make for you? That's the bottom line in determining. If it's not going to make you 3, 4, 5, 10x, you shouldn't be buying the equipment at all. Even at 10%, it doesn't make sense. If you're not going to generate 4 to 5 times the equipment, the payments in the monthly payment, you probably shouldn't even be buying this equipment.
Yeah, Credit Card would say reevaluate your business line. The other thing with this is that when you guys talk to customers, and Alex, you're the one that really talks to most of the customers on this end, is what guidance would you give them? Do you break things down as an account specialist for them? Do you simplify this? Because business owners are crazy. We have a lot of things going on in our head.
Right.
And that's what DCF does is for your customers. You do break this down and say, hey, here's where we're at, and this is why. A bank isn't going to. We talked about it on a prior episode. I think Alex was with us. Banks don't tell you the why, but we do.
Right. And like Credit Carl said, a bank will just turn you away, tell you no, and kick you out the door. Versus we're going to pull up your credit report, tell you exactly why your rate is the way it is, and make sure you have that information so that you as a business owner can know where you stand within a credit bureau and better strategize for your business.
We actually just had a recent, it was actually Alex's customer that felt their interest rate of 20% was more than what they deserved. Unfortunately, their credit situation didn't merit anything better, and they were in that high teen rate. And I actually spent some time educating them and letting them know and showing them with a graph similar to what we have here of they thought it was egregious that they were paying over the term of the loan they were paying $4,000 or $5,000 or $6,000 in interest, and they thought they should be paying much less. But once I broke it out and was able to say, okay, like in example number 2, only $93 a month is going towards interest. You're going to buy the equipment either way, so your actual difference is only this $93 a month. How much income is this equipment going to be making you as a delivery vehicle? And that was going to be making them, I think, $4,000 or $5,000 a month. And my question to them was, are you now going to either wait, because they're like, well, we're going to wait for our credit to get improved. And I'm like, okay, so you're going to wait 90 days to get this piece of equipment, and as opposed to buying it now, paying this $93 a month in interest, getting the income it generates today. So that's what, $515. So if you wait 90 days, you're giving up $15,000 worth of income to your business and possibly not getting the equipment at that time because it's no longer available. Does that make fiscal sense in your business? It doesn't. And once we had that conversation with the borrower and they were able to understand that it was actually not to their benefit to wait, they went ahead and understood the mechanics of the deal, understood where the pricing was, and understood it's going to be valuable to them to move the equipment and move forward today.
Jason Credit Carl says that's a grand slam. That is exactly what we are trying to educate the consumers on. there's a time and a reason that, yes, having lower interest rates makes sense. But in terms of businesses, you really do need to look at bottom line dollar and how that ROI computes to you, the audience listening. Listen, we love these questions, and please know that the numbers on the screen are just simplified numbers. Obviously, you're doing loans. You just did a loan for $400,000. The interest rate on that is probably huge, but you guys at DCF are going to make and help them, guide them to like why this makes sense or if it doesn't.
Right.
I've heard you on the phone before, Jason, tell us like, hey, this fiscally, I think you said, doesn't make sense. So before we wrap this up, is there anything you guys want to add to this episode in relations to making sure the bottom dollar makes for the company?
I just want to add that even if you don't think your rate is exactly where you'd like it to be, we're going to work hard to make sure that we can get you the best one we can. And if it's not within your expectations, we're going to let you know exactly why, so that you don't feel like you're getting turned over by a credit company.
That was a great answer, Alex. I love that. No, I don't think I have any follow-up on that. I think, Alex, you did a great job, and I appreciate you being back for a third installment.
Thank you, Jason.
Love having you. Look forward to having you back again soon.
We'll definitely have Alex on again. Jason, send it away. Where can people find you at and ask their questions?
You can find us on all of the socials, Instagram. You can find us on YouTube, directcreditfunding.com, on the internet, directcreditfunding.com. You can reach us directly physically at 888-844-7676. We'll get you to a live body here at Direct Credit Funding.
And don't forget, you can now apply for a loan right on the website at directcreditfunding.com. Until next time, drop your questions in the DM and have a good time.